Section 2 represented the major chunk of this reading. We now come to Section 3, which is a relatively short section and deals with some practical issues in capital structure policy. And I think this excerpt from the curriculum is very useful. Although capital structure theories should serve to inform an analyst's decision-making process in valuing a company, there are several practical aspects of capital structure to consider. These include the evaluation of company credit worthiness by independent agencies, an understanding of the industry to which the company belongs, and an analysis of the legal, institutional, and macroeconomic environment in which the company operates. Now, based on this, there are three subsections in this particular part of the curriculum. So let's talk about 3.1, debt ratings. Debt ratings are an important consideration in the practical management of leverage. As leverage rises, rating agencies tend to lower the rating of the company's debt to reflect the higher credit risk resulting from the increasing leverage. Lower ratings signify high risk to both equity and debt capital providers, so therefore demands higher returns. Why would a company worry about this? When a company is raising debt, if rating agencies such as Moody's and S&P give a low rating to the company, then obviously the cost of debt will go up. And not only the cost of debt, even the cost of equity goes up. So that is the key point over here. I'll not spend much time on this for several reasons. We are just touching on the main point over here. This material is covered in much more detail in fixed income. There is a full reading on credit analysis at level 2, and there was also a reading on credit analysis at level 1. So I don't think this is too testable in the corporate finance context. All you need to know is that when leverage is higher, then all else equal, that will cause the debt rating to be worse. Now, you are a financial analyst. What are the issues that you look at when evaluating the capital structure policy of a company? In evaluating a company's capital structure and cost of capital, you should consider several factors. What has the company's capital structure been over time? If you notice that in the past the level of debt was low, and now the level of debt is increasing, that would be a cause for concern. You should look at the capital structure relative to competitors who have the same level of business risk. Again, if the company you are looking at has a higher level of debt relative to competitors, then that would be a cause for concern. Even within a given industry, you need to consider company-specific factors such as the quality of corporate governance, because this will impact agency costs. All else equal, if a company has weak corporate governance, then that would be an area of concern for you. The next few bullets deal with cost of capital. What happens to the cost of capital as the debt ratio is changed? This is important because if you think about a company and let's say debt to equity is on the x-axis, we've already talked about the fact that as we increase debt, initially WACC comes down. WACC is lowest at some level, this is the optimal debt to equity ratio, and then WACC goes up again. The value of a firm is maximized over here. So if you as an analyst determine that a company is here somewhere, then that tells you that there is an opportunity for the company to take on more debt and reduce WACC or simultaneously increase value. At what debt ratio is the cost of capital minimized and the company value maximized? So I've already talked about that. Knowing where the company is only helps you if you also have a sense for the optimal capital structure. To what extent are stock price and company value affected when market conditions make it difficult or impossible for a company to maintain its optimal capital structure? So this is another factor to consider. And then here is the final point for this slide. The financial analyst, which is you, is not privy to the company's target capital structure. but rather can evaluate the company's ability to handle its financial obligations and the potential role of costs of financial distress in determining how much financial leverage a company can handle. So putting this in simple terms, if you are evaluating a company where the cash flow is very cyclic and heavily dependent on the business cycle, then obviously you would be concerned if the company has taken on too much debt. So you need to evaluate the target capital structure in the context of the company's operations. Leverage in international setting. We've alluded to the fact that when you think about an optimal capital structure, you need to worry about company-specific factors. You need to worry about the industry in which the company operates. A third area to look at is in what country or what economic zone is this company operating, because different countries have different cultures, and as we'll see over here, in some countries there is a tendency to take on more debt, in other countries there is a tendency to take on less debt. A company's capital structure largely depends on company-specific factors such as the probability of bankruptcy, profitability, quality and structure of assets and growth opportunities. Beyond these factors, the company's industry affiliation as well as the characteristics of the country where the company operates can also account for differences in capital structure. So I don't think this is overly testable, but this is good general knowledge and it is mentioned in the curriculum, so you should know this, and it is also mentioned in the learning objectives. Taking total debt into account, so short-term debt and long-term debt, companies in France, Italy and Japan tend to be more highly levered than companies in the United States and the United Kingdom. So take that as a given. Focusing only on the use of long-term debt. Now notice the distinction. Top bullet talks about total debt. The second bullet point talks only about long-term debt. A different picture emerges. North American companies tend to use more long-term debt than Japanese companies. All right, so remember this fact. Companies in developed markets typically use more long-term debt and tend to have a higher long-term debt to total debt ratio compared to emerging markets. Why is this? Probably because in developed markets, the legal institutions and the capital markets are more developed, and therefore it is easier to issue long-term debt. In emerging markets, the capital markets are not as developed, the legal framework maybe is not as good as it should be, and therefore companies rely more on shorter-term debt. For this particular part of the reading, I think either you can go through the whole reading, but it is essential that you understand Exhibit 6, which captures the essence of what is in this section. You are given some country-specific factors, and then based on those factors, we look at whether the debt-to-equity ratio is going to be relatively low or relatively high. And we'll also look at whether the debt is more likely to be short-term debt or long-term debt. You can go through this, but most of this is fairly logical. If the legal system is efficient, if the legal system is relatively efficient, then the amount of debt can be lower. Why is this? With a strong legal system, people would be more comfortable with equity-based investing. Why is that? Because think of it the other way. If the legal system is not very strong, then I would want more assurances that I'll get my money back, and that happens with debt-based investing. Also, if the legal system is efficient and strong, then it will be easier to have longer-term debt relative to short-term debt. Legal system origin, I don't think this is overly important, but it's good general knowledge. Very broadly speaking, there are two kinds of legal systems in the world. One is called the common law system, and the other is called civil law. Common law exists in the UK, America, and many of England's former colonies. Civil law exists mostly in continental Europe. Civil law came from the Roman Empire, and common law came from sort of the British Empire. So just take this as a given that where there is more common law, debt to equity ratios are likely to be lower. The reason is that in common law, there is greater protection for shareholders. The others are fairly self-evident, and I would want you to actually read through the rest of this table and try to remember as much of this as possible. Now, a quick summary of this reading. We talked about Modigliani and Miller's Prop 1 and Prop 2 without taxes and with taxes. What I'll do here is just summarize with taxes, because if you remember this, then going to the no taxes scenario is fairly straightforward. Value of a levered firm is equal to value of an unlevered firm plus TD. If you don't have taxes, then the TD obviously goes away. The cost of capital, this I hope you remember. If you did not remember this, you would probably not be at level 2 right now. And the cost of equity increases linearly with debt to equity. And I would say this is one of the most important formulas in this particular reading, so know it well. When you don't have taxes, then you don't have 1 minus T. If you do have taxes, then you have 1 minus T. Also, make sure that you understand the assumptions. Understand and remember the assumptions behind these propositions, and these are fairly restrictive assumptions. Then we talked about the cost of financial distress. There were two categories. One is when there is actually financial distress and bankruptcy. There they are the costs related with financial distress and bankruptcy, plus there are some indirect costs because you can't conduct business as usual. The other category had to do with probability of financial distress. Even as the probability of financial distress increases, that increases cost of capital and hurts your ability to do business. Then we talked about agency costs. This results from the fact that there is a conflict of interest between managers and owners. The costs of asymmetric information. Asymmetric information deals with the fact that insiders and managers know more about the company and more about cash flows and more about risks relative to outsiders. Static trade-off theory is important. So here we took this relationship and added the fact that there is a reduction in value associated with the present value of financial distress. Then we talked about evaluating capital structure policy. You need to understand the company specific factors, you need to understand the industry, and you need to understand the country in which the particular entity is operating, and then look at the capital structure in that context. And finally, we talked about leverage in an international setting, and there you need to know the table that I just mentioned. So that is it. As always, go over the summary in the curriculum, do the learning objectives, make sure you can say something sensible about every learning objective. I've covered most of the examples, but try to do them on your own. There are not that many practice problems, but still do the ones that you do have in the curriculum. And if you have time, then do practice questions from other sources.